Okay, I wanted to create a series of videos on YouTube that give you an exact path on how you can get started with technical analysis and trading and price action. So consider these set of videos a sort of a course on price action and technical analysis. Naturally, I'll start with the very basics, explain everything in detail, and eventually we want to get to a point where you can start trading with the help of these videos alone. It's quite an audacious goal and I'll do the best that I can, but I really hope this serves you in some form of the other. And actually, because I'm talking about it, it's also going to refresh a bunch of concepts for me. So I think it's going to be brilliant. I have a slide in front of me, so I'm going to constantly refer to it, but let's get started right away. All right, this is video number 1 in a series of videos where you and I are going to together look at price action and technical analysis. So let's begin right away. Let's talk trading. Naturally, the rewards that the stock market is going to dole out to you, if you read it correctly, they are enormous, which is why the stock market attracts all of us. But the penalties it'll exact from you can be calamitous. But the point is, it'll only exact penalties from you if you are careless, dozing, or uninformed. If you're careless, which means you're not checking out your portfolio when you should be, even if you work a 9-to-5 job, come back home and look at your portfolio. Look at your portfolio over the weekend. You're going to have to go the extra mile if you want the stock market to give you certain rewards that it reserves for the minority. Secondly, let's just quickly compare the fundamental and the technical approach. I've covered this in another video, but we're going to get right into it for the sake of this series of course, right? The fundamental approach really believes in statistics. You want to be looking at P&L statements, the profit and loss statements. You want to be looking at cash flow statements, balance sheets. All of this data can be acquired from the annual report of a company, which is available on every company's website. And here you want to be talking things like plant capacity and what the competition is up to. Clearly very complicated, but this is the fundamental school of thought. Then we have the technical school of thought, which relies on the study of the market itself and then deducing from that the future price trend. I'm going to repeat this. With technical analysis, we're not only studying what the market is showing you today, but you're studying what the market has shown you in the past. So you not only study today's price behavior, but also the historical price behavior, and a combination of these will lead you to the probable future price behavior. That is quite interesting. This is what a doctor does with you as well. When you turn up at the doctor's clinic, you meet a physician. He's going to ask you what symptoms you have, what's been going on in the past, whether you've been sleeping okay, whether there's been some stress in your lives. So clearly, he's looking at the present and the past to come at a conclusion about the future, which is what technical analysis does. Clearly, once we proceed, we want to combine both schools of thought. I think both are beautiful. So we want to operate with a techno-fundamental approach, but more on that later. Then we want to discuss that prices move in trends, and these trends tend to continue until something happens to change the supply-demand balance. This is exactly why we believe in technical analysis, why we even look at price charts, because history suggests and the market price behavior suggests that these prices don't move randomly. They might look very random to you, but they move in concrete trends. You have the upward trend, you have the downward trend, you have the sideways trend. So you have clear trends, and these trends are likely to persist until something happens that reverses it. So when stock prices started crashing during COVID, something had to transpire to reverse that trend. And since then, when stocks have started rising, when they've entered an uptrend, the stocks will continue to be in an uptrend until something massive happens to reverse this bullish scenario as well. So a trend is not easily reversed, which is what Newton said, that an object in motion is likely to stay in motion unless you have external resistance applied to it. Lastly, we look at technical analysis because there are certain patterns or formations that form on the charts. So certain patterns, formations, levels or areas that appear on the price chart which have concrete meaning to it. And while these are not infallible, the odds definitely become favorable. Once you are aware of these patterns and these formations and certain levels and certain areas, you will realize that the market attaches a ton of meaning to these areas. And trading these areas won't make things infallible. It doesn't mean that you're going to have a 100% success rate. Nobody has a crystal ball in the market, but this means that the odds are highly in your favor. For instance, if the stock is in a definite uptrend and you trade it moving out of a proper base and the volume accumulation seems very healthy, the odds are in your favor that you're likely to make money. You still may not make money, but then of course you're going to learn from it. Moving on, let's talk about mindset a bit. And I think this is so important, not only for trading, but in life. You have to believe within your soul and within your psyche that you can make it in the markets. You must believe in your abilities. So Mark Minervini says that everyone has a champion trader aside, whether you're a man or a woman, whether you're young or you're old, whether you're really smart or you're not. There's a champion trader inside everyone. It's just a matter of knowledge, crazy desire, and persistent commitment. When you combine these three, there is nothing that's going to stop you from becoming a great trader. Knowledge you're going to acquire from videos like these and from literature that I'm going to guide you to, and other podcasts and so many other resources. Then you have to have this burning desire within you to become a good trader or to figure out the stock market. And once you have these two things, the only thing remaining is just commitment. You've committed to the process. No matter how many times the market sort of knocks you down, you're like, I'm going to get back up. So what do winning traders do? They seek role models. You want to have a good mentor, you want to have a role model, and then you want to chart a path to success. And you're going to chart a path to success by constantly studying literature. And then you want to analyze and learn from your mistakes, because mistakes you're going to make. You're going to make plenty of mistakes in the market, but the more you learn from your mistakes, the better off you'll be. And the way you learn in the markets is that whenever you take a loss, you tend to analyze what went wrong, where did you go wrong, and try and certainly not repeat that in the future. Thirdly, you want to become process driven instead of result driven. I know we're all out here in the markets to make money, but sometimes just become obsessed with the process. I also follow that for my life. I go to the gym for gains, but I'm not really thinking about how big my bicep is or what's going on with my muscular body. I'm just thinking about the process. I want to be sleeping on time. I want to be eating clean food for health and longevity and muscles, and I want to be hitting the gym consistently. When I take care of the process, the goal is eventually going to take care of itself. So that also reduces a bunch of psychological stress. And lastly, you've got to put in the hours. Trading requires a ton of homework, but not only do you need to put in the hours, you must constantly examine your results. Where are you going wrong? How could you improve? So you want to always tweak your approach and make incremental progress. With this said, we're going to jump right into what technical analysis is. Very interesting. Technical analysis is the study of market action, primarily through the use of charts for the purposes of forecasting future price trends. So we are studying market action. We are using charts to study market action. And why are we using charts? And why are we studying market action? So that we can forecast future price trends with a degree of certainty that is probable to transpire. And what is market action? It is simply price plus volume. And this is also called price action. So once you're studying price and volume, which is on the charts for your perusal, you're basically studying how the market is behaving, and this is called price action. In other words, the rationale behind us studying technical analysis and focusing on price action is that price action discounts everything. Whatever the market knows about a particular company today and going into the future is discounted into the price. So if a positive development is about to transpire for a particular company, the market will know that, it's going to discount it, it's going to be reflected in the price today, and you want to be aware of the price action to take advantage of it, which is why some stocks might be rising and you can't know why. Perhaps the next few quarters are going to do well. Even if today quarterly results are great, the stock price could be consistently falling because the market thinks that the next few quarters are going to be absolutely dismal. So the market discounts everything. Secondly, we've talked about this, but prices move in trends, and these trends are discernible. And lastly, history repeats itself. So when you study the past crashes, you realize that things were quite similar to recent crashes. Stocks like to form particular bases that repeat in every other stock and every other sector. Not only do you have price action discounting everything, but that prices move in trends and history repeats itself. For these three main reasons, we focus on technical analysis. We want to discuss that if prices are rising for whatever reason, if a stock price is rising, it is only rising because demand is exceeding supply, and therefore fundamentals must be bullish. You want to think about this deeply and you want to chew on it, the technical analyst is actually indirectly studying fundamentals. When he sees a rising stock price, he knows that the stock price is only rising because there is demand for this stock in the market, at least demand that exceeds supply. And why would demand exceed supply? It would only exceed supply if the fundamentals are bullish. Therefore, the technical analyst, in the sense of studying price, is studying fundamentals as well. If the price is rising, he doesn't care to know why the price is rising. It's good to know why it's rising, but sometimes you're not going to be aware. The prices are simply rising, and therefore the fundamentals must be bullish. The fundamentalist actually studies the cause of market movement. Oh, the market is rising. Is there more liquidity in the market? Are interest rates lower? The technical analyst says, the technician says, I'm just going to study the effect of the market movement. I'm not going to study the cause of market movement. I'm simply going to study its effect and try to make money, which is what we're all wanting to do in the market. Charts, what do they represent? They simply represent the bullish or the bearish psychology of the marketplace. They do not in themselves cause the prices to go down. Please understand, if tomorrow you have a bullish scenario setting up in a stock, for those who are aware, if a stock is forming something called an inverse head and shoulder, please don't think that just because it's formed, it's going to make sure that the prices go up. The inverse head and shoulder has formed for a particular reason. If the stock is constantly gapping up, and all of these are terms that I'm going to get to in a while in the future videos, but if the stock is gapping up, please understand it represents a market psychology which is bullish. So charts don't make the stocks go up and down. They simply represent bullish or bearish psychology. So if you have a chart in front of you, it's giving you a lot of data and you want to work with that data. So your aim is not to outguess or outsmart the market. If you do that, you're going to face ruinous losses. You must simply study what the market is telling you. You must simply study what the chart is telling you. Don't try to predict and trade accordingly. One of the major strengths of technical analysis, and which is why I highly recommend that each one of you get exposed to it, is that you can virtually adapt to any market or sector. You can trade NASDAQ stocks, you can trade Australian stocks, you could trade Indian stocks, you could trade commodities, and you could trade crypto. You can't do this if you're only a fundamental investor, because how would you know the fundamentals of every sector and every market and every company? That would be very hard to acquire an expertise in. So the analyst is always wanting to realize which sector is getting hot. When I mean hot, which sector is receiving massive inflows, and then he moves his money there. So you could be going from one sector to another if you're a technician. However, if you're a fundamental analyst and you are an expert on hotel stocks, how are you going to shift to oil stocks once they start moving? So it's always worth your time to be into technical analysis. And now we're going to get into Dow theory. And once we're done with Dow theory and identifying trend, we're going to end the video. But this is a very important point, so you might want to watch it until the end. Dow theory is based on this gentleman called Charles Dow and Edward Jones. So what these guys did was they had a company of their own back in the day in 1890s. Dow published his ideas in a series of articles for Wall Street Journal around 1890s. He never wrote a book, which is quite unfortunate, in fact. Dow theory still forms the cornerstone of the study of technical analysis. So a collection of his articles actually led to the Dow theory, and this gentleman was the first one to make a stock market index. Today we have indexes like Standard & Poor's, Nifty, small cap, mid cap. I mean, so many indexes out there. Charles Dow was the first gentleman to create an index, which was the 12 stock industrial index and the 20 stock rail index. Initially was different, but this is what it led to. And these indexes basically represented the health of the economy as a whole. So he said, if these 12 stocks of the industrial index are doing well, it can be presumed that the market is doing well, which is what we look at today. Oh, if Nifty's up, things are good. If Nifty's down, what's happening? Nifty's just a collection of 50 large stocks of India, right? Now, Dow theory has certain tenets which are important to know. I'm going to discuss the most important ones, that the averages discount everything. We've discussed this before. Whatever Nifty is representing today, it represents all the information there is to know out there in the market and what's going to affect stock prices going into the future. So all you need to do is study the averages. There are three trends, three concrete trends, which are uptrend, a downtrend, and a sideways trend. So an uptrend is marked by higher highs and higher lows. So a stock is sort of climbing a staircase. A downtrend is sort of a lower lows, lower high situation. where the stock is coming down a staircase. Clearly, an uptrend is where the stocks are rising, which is where you want them in your portfolio. A downtrend is where the stocks are falling, which is where you want to avoid these stocks from your portfolio. Lastly, there are three phases that happen in a stock. So there's the accumulation stage, where astute investors are actually buying a stock. This is also called stage one. Then you have the public participation phase, where you have rising prices and better news, which is also called stage two. What these stages are, I'm going to get to them later, and it's going to be quite an interesting discussion. And of course, you have this distribution phase, where the astute investors that bought in the accumulation phase are now actually selling stocks. Here, the public may still be buying stocks, and which is where they sort of get trapped. So after the distribution phase, the stocks start falling. So I'm going to repeat for your convenience. You have the accumulation phase. Because of that accumulation, stocks start rising, and this is the public participation phase. You have good earnings report, everyone's talking nicely about the stock. And then on top, you have the distribution phase, where people who bought down here are now selling up here. And then the public is like, what's happening? Why is the stock falling? I can't seem to make sense of it. The third tenet of Dow theory is that volume must confirm the trend. Therefore, in a bullish market, if stocks rise, they must rise with expanding volume. And when they fall, they must fall with diminishing volume. Volume basically tells you how many buyers and sellers are active in a particular stock at a particular given moment. Again, this is something that I'm going to get into in the second video. And lastly, and this is something we've discussed, trends tend to remain intact until definite signs of reversal are in place. So if you have a stock that is stuck in a downtrend, it is forming lower lows and lower highs, it just consistently falls, please don't try to touch it unless you have very concrete signs of reversal, unless you have a very concrete stage one base forming that causes its reversal to take place. And lastly, to figure out what trend the market is in, you need supports, resistances, and trend lines. So studying supports and resistances and trend lines is very important as well. For the purposes of this video, we're going to discuss what supports and resistances are. Support is an area where buying demand overwhelms selling pressure and the price bounces from said area. So if a stock has support at a particular level, let's talk Zoom. Zoom has a support level at $60. Somebody out there wants to buy Zoom at $60, which is why it keeps bouncing from this level, because if someone wasn't buying at $60, the stock price would fall below this level, which it does not, based on today's price action and the price action of history, so the historical price action. Secondly, resistance is the opposite, where selling overwhelms buying. So HDFC Bank has this massive resistance at 1700. So the very simple concept of resistance, if you were aware of it and if you actually applied it in daily life, you'd realize as long as HDFC Bank does not breach 1700, you don't want to buy it. It was trading close to 1700 and had this massive fall on an earnings report. Third, for an uptrend to continue, each support level must be higher than the one preceding it. This is a higher high and higher low concept. You have a staircase fashion. If you have an uptrend, of course, you want the stock to make higher and higher supports. And let's talk about psychology of support areas. This is discussed in this book called Technical Analysis of Financial Markets by Murphy. Again, I highly recommend this book. This is discussed on page 59. When prices rise, traders who bought the support, traders who bought at $60 are hating that they didn't buy more. Therefore, they are waiting for the price to come back to $60 so that they can buy more. So $60 becomes a support. Traders who shorted at support, who bet that the stock is going to fall, are now waiting to enter their short position at break even. So should the stock come back to $60, they're going to end their short positions, which is going to give some bounce to the stock. Those on the sidelines who haven't participated yet are seeing that the stock is bouncing from $60, and therefore they're waiting for $60 to come so that they can again build new positions. So they're waiting for the support to enter. And lastly, what this means is that everyone tends to be invested in the same level of $60, which gives it so much importance and it acts as a support. This is the psychology of support and resistances. However, you need to remember that if a support is broken, if it's breached, this level now becomes a resistance, because whoever bought at $60 and the stock starts trading below $60, should the price go to $55 and then come back to $60, the people who were in a loss so far will want to get out at break even. So they want to get rid of their positions. Similarly, once a resistance is breached, now this level becomes a future support, which of course I'm going to give you examples of the same, which make it so evident that these patterns are very, very important in the market and you need to know them properly. And that if there's a support which is breached, it becomes a future resistance. If there's a resistance that is breached, it becomes a future support. With this, I'm going to end the video right here. I'm sure it's quite heavy for somebody who's beginning, but you want to watch it over and over again. And also you want to subscribe because I'm going to be doing a series of videos now. So make sure you're following this series. I'm going to name it a certain way. I haven't decided on the title yet, but make sure you subscribe and let me know your thoughts down here if this helped you and whether I should go faster in the next video or slower. I don't think faster is going to be possible because my throat is parched right now. But yes, I hope you enjoyed this introductory video. See you for the next one. And of course, in the next video, we're going to be discussing things like candlesticks. What is volume? What is a moving average? What are closing ranges? So a lot of these basic concepts you're going to be touching upon in the next video. And these concepts comprise chart construction. Until then, have a good one and make sure you take your notes as well. See you for the next one and follow me and subscribe, like, comment, whatever it is you want to do. Good one and take care.